All right, good afternoon, everybody. Welcome to the Multifamily panel for the Only Brooklyn Summit. My name is Adam Hess. For those of you who don't know me, I run the Multifamily division for TerraCRG. It's the fourth year in a row I've done this panel, and every year everyone asks the same questions and are thinking about the same thing. Are we at the top? Is there more room to grow? So hopefully from year to year we'll keep going up and up and up, and things will stay on the same trajectory they are in Brooklyn. I just wanted to bring one quick graph up there onto the screen for everyone to see, and then I'll kind of go through who our panelists are. That upward line is transaction volume from 2012 to now of just multifamily in Brooklyn. So the first year I did this panel in 2012, it was 1.3 million. 2013 is 1.7 million. Billion. And 2014, it was almost 2.6 billion. I didn't want to bore you guys with too many graphs, but I guarantee you if I put the price per square foot and the price per unit graphs up there, it's the same thing of the median sales. I did not put the cap rates up there. The line is directly down in the other direction, so I didn't want to rub in anybody's faces with contracting cap rates. But I think with this overview, and you see what's going on with the market, we're really lucky to have, I think, the guys on this panel that are really, really driving that growth. We have Kunal Chothani from Akelius. Akelius is one of the biggest landlords in Sweden, and they made an invasion into North America in Toronto. And they're buying up buildings in Crown Heights like they're Swedish meatballs. So I'm sorry, I promised Kunal I wouldn't make any meatball references. We won't do any more. But Kunal's bought or in contract in over 400 units in Crown Heights. They're very active. We'll ask him about some of his transactions. James Eisenberg from Urban American. I think everybody knows Urban American. Every time you see a huge deal pop up in the Real Deal, James's handsome face is up there. They own a couple thousand units around the city. Seth Weissman, Weissman Equities. These guys made one of the most courageous jumps. They bought and did a lot of deals in Chelsea, and they switched from Chelsea to Bushwick. So I know Seth's name. My Bushwick Bed-Stuy guy, Matt Cosentino, must say Weissman Equities 25 times a day behind me at my desk. So they're big Bushwick and Bed-Stuy guys. We'll have them talk a little bit about that. Andrew Miller, Excelsior. Andrew did a very big deal last year. Bought a large deal in Crown Heights, which I don't know if it's a big secret, but they're currently selling. So if Andrew looks flush with cash, it's because he is. And then we have Josh Zegen. I think everyone knows Josh from Madison, Madison Realty Capital. Josh also is another guy who's been in this market for a long time, seen the up markets and the down markets. Owns a couple thousand units, and everyone knows is a very active lender. So just I think that you guys, I think everyone's kind of following this, and on a multifamily panel, I think if we didn't talk about it, it'd be a bit crazy. You know, I know you guys all, like me, were up until 12 last night waiting to see if Albany got its act together and put the rent regulation laws back into effect, or if they let it lapse. I know you guys all, when it lapsed tonight, sent out your $5,000 a month leases to your rent stabilized and rent control tenants. So I mean, I want to ask you guys. Obviously, you know, the landlord environment is less friendly now. I mean, they're talking about negative. They're talking about stabilized increases staying the same, 0% increases, doing away with the vacancy increase, maybe putting it to 7% or 0%, and raising the threshold for destabilization. So this hasn't stopped any of you guys from buying. So I guess my question is, how do you guys approach this, and how are you accounting for these changes or potential changes in the market when you're buying buildings? I don't know, Kunal, maybe you just want to jump off and start here.
We were closely watching what's going to happen right now in Albany, and to some degree, I think it's given a little pause on anything new coming in, and we would have to readjust how we're underwriting deals going forward. Our strategy's always been not to pursue buyouts. And if apartment does become vacant, if they were to change the threshold on us on popping over the 2,500 per month, I think that would definitely impact our strategy and how much money we would be investing into vacant apartments. But like everybody else, we're waiting on the sidelines to see what happens here, and going to sharpen our pencil when we do learn what the final result is.
Does anyone else in the panel really believe that they don't pursue buyouts? No. I'm not buying it. I'm sorry, Kunal.
I will tell you that we do not. I think we've done 3 buyouts in our entire history of our company, and that's only because for extenuating circumstances. I'm being completely honest. We underwrite all of our properties to natural vacancy, and there is a healthy turn of rent stabilized apartments that a lot of landlords probably don't realize is going on, but we've been able to make a pretty successful business of staying out of that game. It's a question of what you underwrite to, and if it's too expensive, you don't buy it.
So Ed, I got us off topic a little bit, but what are you guys doing? What specific actions, or what are you guys doing to kind of adjust your model or account for the changes in the rent stabilization laws?
I literally just quit Excel because I can't it sounds fine. I literally just close it because it's impossible for us right now to underwrite anything until we find out what metric is going to flip. And you can think about the doomsday scenario. I honestly think, and hopefully I'm not giving too much to our competitors, but I think that Cuomo stepping into this argument is probably the best thing that's ever happened in this argument to landlords, because before it was either 1 or 0, and that's just too much uncertainty. And Cuomo's a negotiator. He's going to go in there. He's going to say, look, no, De Blasio's not going to steal my thunder. It's a state law. It's not a city law. He can run the RGB, but it's a question of whether we're definitely going to renew rent stabilization. It's just a question of how. And if I've got city councilmen and state assemblymen getting arrested outside my office, they're showing me up, and I'm Cuomo. I'm not going to be shown up. So, but him going out and writing the op-ed piece that basically says the worst case scenario that landlords could think of really is a signal to say, like, look, this is all just drama and posturing, but get ready, guys, because you're going to have to give up something. Because I'm going to make sure that both sides get something in this. And really, both sides can actually claim that just the renewal of stabilization is a victory, right? Because it's on the table to go away. But we're going to get hit with a metric that's going to change. It's either going to be vacancy increase. It's either going to be no prefs. It's going to be something that's going to affect our model. And you really can't grow apartment buildings at a 0 or 1% increase if that's across the board. So sorry if that's sort of a doomsday, but something's going to happen. Until it does, there's uncertainty.
But I want to add to that. I mean, we certainly consider turnover when we look at any acquisition, and not knowing the rules of the game certainly make it impossible to play it. But that should play out in the next, this week or next week. But we really focus on the ability of design to add value to apartments, and that could be, converting awkwardly laid out 2-bedroom to a thoughtful 3, putting in washer dryers. We really are in areas like, as you said, Bed-Stuy or northern Manhattan, though I promised I wouldn't talk about anything non-Brooklyn today. And what we found is that a critical part of our business plan, even more so than the turnover, is the ability to look at a building, look at the layouts, look at the design, and think about, the opportunities for rental growth and the quality of tenancy from that perspective, as opposed to, can I just, churn the building?
Andrew, where are you on this whole rent stabilization?
Taking that, I think, one step further is that all costs a lot of money. So with the vacancy increase that James and I were talking about earlier, to us, the vacancy increase isn't really the metric that's going to throw the game for us. It's, as James was saying earlier, it's about the increasing the or removing vacancy or decontrol completely. That's a huge game changer, which I don't believe is going to occur with the current administration. So That's the way we're looking at things as of right now. And obviously, everything's changed and subject to change going forward. But so everything's a little bit on halt until the final decisions come out.
Josh, what are you thinking about the future on rent stabilization?
I mean, similar to a lot of the comments, there's just this sort of cloud of uncertainty. But, we also look for the free market tendency to obviously natural turn and try and really add as much value through converting layouts, reconfiguring unit mix. And I do think also with land pricing the way it is, it's going to really push a lot of developers not to develop, rentals. And with the changes in 80/20, that's going to push pricing in terms of the free market units. And as we reconfigure layouts, rents are up in Brooklyn, in a lot of these markets, 5 to 10% in some places. So this year in particular, lack of supply relative to overall demand, and we're seeing a huge push in rents on the free market as we've turned layouts to meet more of a Manhattan kind of standard in Brooklyn.
That was actually, that nicely leads me into my next question. We saw between 2000 and 2012, we saw in Brooklyn a 77% increase in the rental market. I think most of the estimates now from last year to this year are about 5%. And then coming out of 2008, we had consistent year over year, 11, 12, 13, 10% annual increases in the rental market. I think a lot of people and a lot of owners that I talked to a couple months ago said, we saw a little dip, and I think the numbers verified a little bit of the dip, but if you looked at all the new rental reports that just came out, it seems like we're heading up again. So my question to you guys, where do you see this rental market heading? Have we plateaued? Do we have a lot of growth? Are we going to hit $80 a square foot and like some of the Manhattan projects right now? Where do you guys see this heading?
Well, it feels like this year is the first year we start to see significant job growth in just the overall New York economy. And a lot of that job growth was in Brooklyn because a lot of the office sort of tenancy has moved. In some ways, either their employees live in Brooklyn and they want to be here. So we're starting to see such a huge migration to Brooklyn in markets like, whether obviously Williamsburg, Bushwick, Clinton Hills, places even like Sunset Park. Where you're starting to see a place like Industry City, which is such a massive project, attract a tenancy that wants to live somewhere near that property. So I just think the supply and demand and job growth figures right now are in our favor, at least for the next 12 months or so.
And I think land pricing obviously is as well as adding to the lack of supply coming to market after this wave of new rental apartments flushes into the market and tenants occupy those. Everything that's going up now is really condo as a function of land pricing. So the supply and demand function in Brooklyn is shrinking as it is in Manhattan. So.
What are you saying over in Bushwick Bed-Stuy market? We have a lot more growth left, or
I
are you
think
guys?
it's funny, that statistic, and I saw the article about rents are up 80-90% over a 12-year period. If you actually look at sort of what the CAGR is in that, it's not so crazy, right? It sort of drops down to like a 5 or 6% annual year-on-year growth. But I think we'll continue to see sort of low single-digit top-line growth in rents. What we're constantly impressed by is the quality of the applications and the tenancy that we're getting. As I mentioned earlier, we do spend a lot of money on renovations, and we deliver what I think is a very quality product. But our tenants, Google, Apple, JP Morgan, they have real credit, real jobs, real income, and it's very consistent. So I think that bodes well for the future of a lot of these neighborhoods in terms of who you're getting and their income potential going forward and the relationship between income and rent.
Yeah, Kunal and I just did a deal together, 40 units on President Street. When we walked the building, it was like 2 p.m, and everyone was home wearing sweatpants with 3 Apple computers open. And Kunal, it sealed the deal for him. He knew it was a great rental market when people are at home in sweatpants using Apple computers in Crown Heights on President between Nostrand and Rogers.
I'm still convinced you guys paid people to sit there and look busy.
It's actually a great idea.
It's been done. Now, to get to Seth's point, when you look at these teens, double-digit growth rates. I mean, the real number is, it does fluctuate between 4 to 6%, and that's a healthy conservative growth, I think, in overall. When you're looking at the teens growth, you have to assume it's not just rent over rent everywhere. It's new territory being discovered by stronger applicants, by higher paying tenants that are looking to spread the load, right? So the conversation that a lot of people want to have is, are these neighborhoods gentrifying, right? And nobody really wants to talk about it, but what it is the concept that there are rich kids displacing underprivileged working families. And when you break it down, what it is you're actually having tenants that are moving in that are paying less than the family that moved out on a per person basis, but they're willing to spread the load because they're saying, look, I'm an actor going to auditions during the day, I'm a barista in the afternoon, I'm a bartender at night. The only thing I'm doing in this place is putting my head down after a couple martinis, wake up in the morning, it all starts over again. I don't need a living room. I got a flat screen TV. I don't need a den. I don't need any of that stuff. But what I need is 2 roommates to spread the load because it's a cool place to live. And so you're seeing higher quality individual tenants and their roommate shares, and that's what these guys are talking about, reconfiguring to that market. When you break down the individual economics to the renters moving in are earning less than the renters who moved out on a individual basis, earner basis. And then when you find that they're saying, all right, well, the rents are going up 17, 18% because it was previously $1,200 and now I'm paying, $1,400, $1,500. That shows up in your double-digit rent growth, right? Along with the North Williamsburg increases, which have actually started to plateau a little bit, right? So it's all about the new territories. And then that's a lesson of the city. Like, is there really not enough affordable housing in the city that we have to go out and parade in the streets and make sure? Maybe not, right? Maybe there is enough. If you go out, and I'm sorry, I only mentioned the Queens, but Queens is a vast borough of high-quality neighborhoods and superior access to Brooklyn. Sorry, Brooklyn. But the fact is there are nooks and crannies.
Where's Queens again?
Queens is
over
it's on Long Island.
Okay, got it.
So, but there's Brooklyn too. I mean, there's neighborhoods out there that have a ton of affordable housing, right? It's just a question of eventually getting there.
I think you're saying who is it affordable for? I mean, at the same time, the city's talking about they want to create jobs and tech jobs and be a 21st century industry, but you have 3 kids, 3 roommates who are the people who need these tech jobs, and they each pay $1,500 a month or $1,000 a month, and apparently
to them that's affordable.
That's affordable.
They're willing to give up space for rent. Right, and be in the place that they want to live. It's a live-work environment.
I mean, the cost of living also in these neighborhoods, forgetting their rent, all the retail that's coming in and occupying the retail amenities for the tenants that are occupying these new apartments is out of range for a lot of these middle and lower class families that have been there for 10, 15, 20 years. And I think that it's very tough for them to continue to occupy this space and occupy these neighborhoods when they're gentrifying at the rapid pace that they are.
And in a neighborhood like Bed-Stuy and a lot of parts of Brooklyn that have big historic districts, the limitations on supply are tremendous. Mm-hmm. So, there's really an incredible tension between the demand for housing and the supply, and there's a lot of limitations. And a lot of it's rent regulation, which artificially restricts what can be built and how much can be built. But a lot of it is related also to these historic districts. And I see in Bed-Stuy in particular a lot of that conflict because you have a lot of people who want to landmark block after block, and it's great to have a lot of 3-story or 4-story brownstones, but those only hold a handful of people as opposed to even a moderate-sized, or mid-sized tower. And I think that's something that needs to be addressed if you want to actually create affordable housing in certain neighborhoods.
Right. So, Kunal, you guys made a big jump into this market. I think the biggest question on my mind when I first saw you guys pop up on a deal was, what the hell are these guys from Sweden doing buying in Crown Heights? So if you can walk us through a little bit, I mean, maybe just give the audience a little bit of background, of a 2-second background on who you guys are, and tell them what you're doing in Crown Heights right now, because I think it is remarkable, and I think it'd be interesting for everyone to hear, why you guys targeted Brooklyn in general, and then the Crown Heights market in particular.
Sure, thank you. So we're a Swedish-based company, one of the largest owners of apartments in Sweden, one of the largest in Germany. The company has made a effort over the last 4 years to focus on acquisitions in the largest international metros. So the company started buying apartments in Paris, London, Toronto, Montreal, and this year we entered the New York market, have purchased about 500 units, 250 in Crown Heights, 250 in Manhattan. It's simple, Adam. It's the jobs. Crown Heights is 30 minutes from whether it's a 2, the 4 or 5, to the financial district and or Midtown. From our office downtown to our President Street property is less than 25 minutes. And in fact, I don't think I even have to go outdoors to get to a half a block away from our property on President Street. Subway's right downstairs in our office, and we're able to pop out of the subway, the 2-5 stop on President Street, and be a half a block away from the property. And so the properties we're focused on buying are in close proximity to subways, ideally express lines, but really 30 minutes door to door from either Financial District or Times Square. I've been at our tenants unions meetings the last few weeks in a row at our Crown Heights properties, and
That sounds like fun.
So it's actually it's a learning experience, and people live in Crown Heights because of its proximity to the jobs in Manhattan. I've heard on the panels earlier, there's a lot of jobs coming to Brooklyn, but it's the jobs in Manhattan, whether it's a rent-stabilized tenant that's a clerk at one of the police precincts, or it's the Apple or Google employee that's moving into a recently renovated apartment. The 30-year residents live there for the same reason that the fresh college grad is moving there. And I feel like a broken record because I say it so often, whether it's to the broker community or to somebody in lending or to another owner, it's a proximity to Midtown and downtown that makes it easy for me. Just draw a little circle, and if it's in the circle, it's something we might look at. If it's outside, it's an easy no for me. But its location, as long as we're near one of the subway lines, it's something that we think has a long-term value. Our model is the same internationally. In Stockholm, we're 30 minutes door to door to the city center. Same thing in London, Paris, Toronto, Montreal. Transportation is a big thing, and as long as people can get to their jobs, it's somewhere they'd be willing to live.
So quick follow-on question to that, and you're probably going to get attacked by all the brokers after this, but so you guys in the deals you do generally close all cash. Is there a reason you guys do this as opposed to financing? Is there a way that the fund is structured? I mean, what's kind of the logic behind that?
Yeah, so
other than the fact that you have it.
There's only so much I can say about that. We are partial ownership in Akelius is traded publicly on the NASDAQ in Stockholm. So we do close all cash in all of our markets, and we're in international cities that trade at a high velocity. And in order to be competitive and get the properties that you want to get in some of these prime locations, you have to be able to move quickly. We go through a lot of the same third-party reports that anybody that is placing financing on an acquisition would do, which provides some level of check. But we do buy all cash. Our portfolio internationally is only levered 50%. Which is public information. So I think the idea is to keep it at that level to protect against any future downturns.
Got it. And Andrew, I know you partnered with an Australian fund, and you guys also made the same jump into Crown Heights, and you're probably flipping those to Kunal as we speak. But just a joke, I think. Talk to us a little bit about, we have a Swedish firm that made the jump, and they're in Crown Heights. I don't want the whole panel to be about Crown Heights, but you guys also made a big jump there. What was the rationale behind that?
So our story, I think, is a little different than Kunal's, which our partner had bought a few thousand houses in Brooklyn prior to us jumping over the river into Brooklyn. And they had been very, very successful with the rents that they were able to achieve on their houses, the renovations that they were doing on the houses, and the locations that they were buying. They got very, very comfortable
This is Dixon you're talking about,
Dixon,
right?
Correct. So when there was a little property that I saw that I thought was an interesting buy, I then followed that up with, we're not going to just buy one small building in Brooklyn. We were going to roll out a platform in Brooklyn, and they were very, very supportive of that. And at that point, we closed on that building as well as another 250 apartments within a month last summer in July. And anyone that bought a year ago has bought right, and it's been a really great process for us. But historically, we were buying in New Jersey with Dixon.
All right. And was there any, other than the market going up a significant amount from last year to this year, was there a specific reason you guys chose now to sell in this market? I mean, what was the thinking there? Was the original plan a one-year hold, or were you looking at a longer 5, 7?
No, the original plan was a longer hold, but when you have partners and you have preferred returns, a lot of the profit for the operating partner is in the exit or in the capital event. So when the market went in the way that it did, it was, we decided that it made sense to exit the properties. And that's a function of just operators with capital partners behind them and that have preferred returns and promotes.
Did you crush it?
We're doing okay.
Okay. Okay. So Josh, James, you guys have been in this market for a long time. James, your family has been in this market for a long, long time. When you guys see and you hear Swedish funds, Australian funds buying in Brooklyn and Crown Heights and Bed-Stuy and PLG, I mean, what do you guys make of this?
James's partner is our partner as well. So we can talk about that.
We actually, for full disclosure purposes, we did partner with Dixon. We were their first multifamily partner in a portfolio in New Jersey. And we've actually had a phenomenal relationship with them. But the Australian, not just Dixon, but other firms that got into it, a lot of it was because the Australian dollar was very strong against the U.S. dollar, and so they could deploy the capital. I don't know about what the currency case is in Sweden, but they can immediately get yield just putting it out, and then there's a yield.
I'm sorry to interrupt, but I just want everyone to know this is the first time in the history of a multifamily panel that the Australian dollar's strength has been talked about. So make a note of that.
But it's not as strong anymore. And at the time, it was a very good play for them to go and immediately get yield. And then there's a yield play going back as well. But I think that foreign investment in New York City real estate is something that's been going on for forever. Whether it's the Chinese, whether it's the Japanese, whether it's the Swedish, the Dutch made a huge play into New York City multifamily in the last 10 years. A lot of them are Dutch pension funds. A lot of are money backed by European. Sorry, that's my reminder to get something done today. I have to get one thing done every day. And that's 365 things to do a year, which is good.
That's actually Ofer's rule at TerraCRG too. Everyone has to get one thing done every day.
I've seen it. Like Adam said, our family has been in the real estate business for a long time, and my dad has definitely lived through a lot of cycles, And in those cycles, there was always a foreign player in there at some point, whether it was the Chinese or Japanese, mostly the Asians, Koreans. Now you're starting to see Saudi money come in and all sorts of stuff. So there's always something out there.
Got it. Josh, what do you think
So,
about all
I mean,
this?
what I think is interesting is in Brooklyn, at least, you've always had foreign capital. Well, the last 5 years, you had some of the foreign investors coming to a place like Williamsburg, a place like Brooklyn Heights, a place like Dumbo. But you started to have that foreign capital come to places like Crown Heights and Bushwick, and it became much more of a global investment forum as compared to a place like, look, Manhattan always attracted all different sources of capital globally, but Brooklyn, you didn't hear that story. And I think that's a huge change over the last few years, that capital is going to places that maybe, not a Williamsburg, which was an A kind of market from 2011 or so on,
It's a very good point, actually.
So let me turn now to a slightly different topic that you guys all kind of touched on earlier. I think Kunal and Seth, you guys both talked about your underwriting natural turn. So when you guys are going in, you're buying these buildings, what's the natural turn you're underwriting as far as how many of the tenants are turning over? I mean, are you underwriting 5% of rent stabilized, 25%? I mean, when you guys are analyzing these deals, not to give too much inside information, but generally, where are you guys underwriting the natural turnover?
That's a pretty private question.
Okay, you don't have.
It's a very situational question. I mean,
Don't worry, there's barely anyone here, Andrew. You're fine.
in our case, we look very closely at the existing tenancy and try and understand, who's there, how long they've been, sort of what the profile is, because that will all sort of inform ultimately what your turnover is, right? A building where everybody's 99 years old is going to be different than a building where everybody's, in middle age. So we look at it on a case-by-case basis, but it's not something we'll ever underwrite where we're relying upon, 50% turnover to achieve our target returns. So we try and be, conservative and realistic in our underwriting.
Josh, what about you?
I don't have a specific number. I mean, we do try and get to like a little over a 6% yield on cost, and a lot of that, or a majority of that, is trying to turn the free market. Sometimes it's duplexing down, sometimes it's using additional space, sometimes it's building up. But I mean, typically it's very hard to just buy a straight deal that has stabilized tenancy for the lion's share of the property.
Kunal, what about you? What are you guys underwriting over there?
It's a property by property case. I mean, something in Gramercy Park is going to be with a high percentage of market rate versus 100% regulated in Crown Heights. It's going to be very different. I think one of the trade organizations had something written a few weeks ago in relation to what's going on in Albany, and said that the stabilized or regulated apartments on a citywide basis turn over roughly 10% annually. So I think it's probably not terribly far off.
James, what do you think?
We have the benefit of having, we currently own, we just sold a large portfolio in Brooklyn, about 1,500 units recently, and then
It was
so we
only
can-
1434, but no
Sorry,
one's really counting.
1434. So it was almost 1,400 units. So, but the that is still within this year. So when we look at when you guys send us a setup, we take everything below the word expenses and we throw it out, and we take we have a portfolio across the city, and we take our own expense numbers, throw them in there, and then we look at the turnover rates, and we really, just on a conservative basis, we don't really trust anything other than what we've actually seen. So we look at the various sub-neighborhoods. They may be a half a point or a point more or less than sort of a neighborhood or borough average, but we'll plug in what we've seen in real life, as opposed to, but those are those numbers. When you look at a setup, you really want a deal to work. That's where you start giving, you can put in a growth story that you can believe in, right? And that's where a lot of people in our business, especially in the workforce sort of value add core plus market, a lot of people have gotten into trouble because they've massaged those numbers. They said, we're going to get 10% turnover every year static. Well, guess what happens? You have a rent roll, and you can't get 10% year over year because your population of rent stabilized tenants decreases. So that's impossible, right? So that's just funny math. But it's a long answer, but we just look at what we've seen, and I think 10% is a little aggressive. I like more like 5 or 6%.
Just want to add one thing. I mean, a lot of that also kind of depends on who you're buying from, because typically, I'm sure a lot of the people on the panel here are targeting buildings from long-term family ownership where maybe the mortgage was paid off and someone just wanted to keep cash flow coming in and didn't want to spend money on buyouts or anything like, or turn units. So a lot of it is, that success rate or that ratio is really dependent on a lot of who you're buying from in general. And
now knowing that James doesn't pursue buyouts, it may be an interesting. I think also what we look at is unit types. So smaller units turn more frequently than larger units. So we take that into consideration when we're looking at setups as well. A lot of people like larger units. Larger units historically just turn less than smaller units. So for us, we like smaller apartments. We like kind of a mix.
Yeah, remind me to come back to that, the unit sizes and how you guys are altering them. But I have to ask Josh a quick question. When guys are coming to you for lending on multifamily, are you also ripping up their expenses and throwing them out, or how are you looking at them?
Well, what's nice about that part of our business is that typically we're lending at a much lower basis than the sponsor is in for. So we don't, obviously we're paying a lot of attention to the underwriting, but we don't have to look at that last dollar the same way you would on the equity. And, as an owner and developer, I know where I would want to buy that deal, and then I'm really looking at 65% of that, because typically in New York, if things go wrong, it's a very long foreclosure kind of process here, so things take a long time.
So I wanted to get back to what Andrew brought up. So Andrew, why don't you jump in on this? I know the question is kind of neighborhood dependent, but talk to me a little bit about when you guys buy. Generally, are you cutting up 3s to 2s, turning 2s to 3s, making 3s into 4? I mean, generally, how are you approaching whether to make the apartment sort of more roommate friendly or more family friendly, I guess, in the other direction?
It definitely is neighborhood by neighborhood, and I think that.
So let's pick Crown Heights.
Crown Heights okay. So Crown Heights, we're finding that the populace out there is a younger, more nimble renter who is happy renting in an apartment that is shared with a number of friends or roommates. So we typically like to renovate Crown Heights apartments in a way that maximizes the efficiency of bedrooms.
Any other neighborhoods that you're having?
I think that James and I were talking earlier about Williamsburg kind of a little bit moving away from that as more families are moving into Williamsburg. I think Park Slope is also they like larger apartments over there. It's more of a family-oriented neighborhood. I think that the neighborhoods with the younger population is where you want to really look to maximize bedrooms in those apartment buildings. So Crown Heights being one of them, Bushwick being another one of them. That's my personal opinion.
And we've done the same thing in Bed-Stuy as well as in
Bed-Stuy,
Harlem. Even taking it further on the bedrooms with the bathrooms where there's not room to necessarily add a second bath, or we don't think we would get the full value for adding another set of risers, et cetera. We've popped out the existing bathroom by about 20% or so, put in a pocket door between the toilet and the to sort of make a flex 1.5, and that's something that for a 3-bedroom, 1-bath share has been very popular. So that if you have those 3 roommates, one person can be showering, the other person can be brushing their teeth, and we've added a half sink. So thinking about ultimately how our customer or tenant is going to use this space and what enhances their experience has been very rewarding, both on the rents we're achieving as well as on the quality of the tenant. And my brother and I, we did a project in Harlem 2 years ago with micro units. We converted an SRO, 200 square foot apartments that we get between $1,200 and $1,450 $1,200 and $1,450 a month on. that are just have shared bathrooms, and they're beautifully appointed. They have furniture with resource furniture, and we get an incredible tendency of young professionals.
Kunal, what do you think about moving to the shared bathroom business plan?
I don't think we're going in that direction right now. We don't have anything that suits itself to that. So
I'm sorry, finish, Seth.
Yeah, but it's interesting to see the marketplace and the positive response we've gotten. And on the shares, it's not only shares, but we also have people who travel a lot for work or not necessarily in their apartments all the time. So paying, they're more attracted to that whole dollar number as opposed to a rent per square foot. Where in a market like Harlem, we're at double the market rent per square foot, and it helps when your unit size is 200 square feet. So.
Talk for a second about, are you seeing, I know a lot of my friends, a lot of people, everyone's, and I think it was said in the panels earlier, everyone is buying a house in Bed-Stuy. Everyone's telling me they're buying a house in Bed-Stuy because of the brownstone stock. Are you guys seeing or considering in any of the buildings you're doing out there going to more of a family-friendly layout? I mean, are we there yet, or are we a couple of years away from that?
So we bought 75 McDonough last year, and the plan there always actually was family layout, family style apartments. The apartments there are about 1,200 square feet. We could have easily cut them up, put in a second bathroom, or actually 2.5 bathrooms, which was what we were considering if we had gone shared. But I think that the market, because of all of the housing stock, is actually in Bed-Stuy, in particular areas of Bed-Stuy, going towards more family-oriented apartments. So we actually made a play on McDonough to convert those apartments when they became available to family-style, large, 2-bedroom apartments.
How did it end up affecting the price per square foot you're underwriting on the rentals?
We were looking at it at a gross basis, so we felt that we were able to get about roughly the same price as brownstones were trading for, unrenovated brownstones were trading for in Bed-Stuy. And if we were able to deliver the finished product and the basis that we were in at, we felt that we were going to be able to attract buyers to that. And it's been, I think, very positive.
So what are you underwriting in rents over there on a project like that?
About $5,000 a month for 1,100 square feet. It's right by the A train. It's a very unique property.
Gotcha. Seth, you were going to...
I think we're not gearing our rental product toward families. We've been taking a serious look at some condo development opportunities. There's very limited condo product in Bedford-Stuyvesant in particular. It's primarily a brownstone market. But what we are seeing, given the rents we're achieving with our apartments, and in the studios, we sort of get in the $1,500 to $1,650 range. One bed's in the sort of $1,650 up close to $2,000 range, depending on the size and the location within the neighborhood. We're seeing a tenant that certainly in a couple years will want to enter the condo market and is positioned financially to do so. So that's something that we've started to take a closer look at. We're watching closely how some of the Brookland projects, Bedford Avenue, are going to do, as well as some of the newer construction coming to the market for the first time.
James, what about you guys? I know you're in a lot of different neighborhoods. You just sold in a lot of different neighborhoods. Depending on neighborhood, how are you guys generally approaching whether to make the apartments larger or smaller?
To tell you the truth, the vast majority of the stuff that we've owned in Brooklyn, we've bought or sold about 4,000 units since 2002 in Brooklyn. And those neighborhoods were predominantly Flatbush, Midwood, East New York, Brownsville, and those are still family. Those are core workforce family neighborhoods. So we haven't, except for the new product that we just bought. We just bought 100 units recently in Williamsburg, in Southside Williamsburg, which is a roommate share market. A lot of those units are already renovated and turned over and cut up into twos into threes and ones into twos, and we'll probably continue going that direction. But our experience, and I'm just trying to stay to Brooklyn, right? But our experience in Brooklyn and the neighborhoods that we've been invested in and done well in so far is basically just keep it the same density and just give a nicer, high quality, much better product that's welcomed into the market, along with improved building systems and commons.
Talk about that. I actually wanted to ask you about that transaction a little bit, the 100 units, the Havemeyer Lorimer package. I always kind of pictured Urban American as more of a sort of central Brooklyn type play. What was it that made you guys jump over there into Williamsburg?
We had an opportunity in 2009. We bought there was a busted condo development on North 5th between Bedford and Driggs, and we bought the note from the bank. I don't mind sharing the metrics. It's because no one will ever get to see this kind of deal again. But it was it was a $7 million note. We bought it for $4 million. The skin was on the building, the roof was on top, but none of the interior. Some of the interiors were completed, but there was still a lot of heavy lifting to be done on the inside. And so we went in there and got everything. We were all in, all out at a basis of $8 million. And then it got, we went to go refi it. We kept a ton of equity still in the deal, but the value of the refi was 11.5, and that was in 2012. So can imagine what it is now, or 2013 rather. And so that was our first stake in Williamsburg. We always kept an eye on that type of market, but we never really thought that. And when we got there, I remember standing there. I was there 3 days a week, and I was like, "Wow, we missed this place. Where did this neighborhood come from? It just snuck up behind us. It's done, And my dad's like, "Oh, go find more stuff in Williamsburg." I'm like, "Nah, it's all done. It's fully baked. Everything's crazy." And then even since then, just things have just compounded on themselves. And so, just the nature of it's kind of like he was saying, if I get off the train. And there's coffee over here, and there's better coffee over here, and there's a good place to get a beer there, and food. And all of a sudden, you find yourself being very familiar with the neighborhood, and you start to understand block by block what's going on. And so you just keep your eye on it. So that's why we were able to pick up that deal.
When you guys bought that package, where were the rents at the time, price per square foot basis, and have they jumped since then? And where are you guys now?
They've come up. We've seen some of them come up. I mean, it's still a pretty recent deal for us. We closed in January, so it's almost a half a year at this point, and we haven't seen, we've seen. I should say we've actually seen a few dollars per foot jump up, but we still have a lot of leases that are in place. So we're actually just renovating our first bunch now. So we'll see what happens once we're done with those.
All right, I'm getting the out of time signals over here. Do we have 2 minutes for? We have 1 minute for 2 questions, or 2 minutes for 1 question. All right.
I'll just say anecdotally, these guys know more than I do, but I was a non-believer, and I've definitely flipped the card on Bed-Stuy. I just didn't get it. Bushwick, I still don't get, and I think there's a tipping point to Bushwick. The streets are just all messed up in Bushwick. You wind up making 5 lefts. It's bizarre. But Bed-Stuy, I think, is actually kind of a really interesting play, and I think there's a lot of yield there.
I mean, obviously, we're biased. We have a lot of buildings in Bed-Stuy, but we've also spending a lot of time in Sunset Park, taking a serious look at that. The work that Jamestown is doing there with Industry City is incredible. So that's another neighborhood that we're interested in.
Andrew, what about you? What's your next neighborhood you're targeting?
I think we're backtracking actually a little bit into Park Slope. We're just seeing some opportunities there that we really love, and we're making a little bit of a play there right now, just basis buying in Park Slope. So I know everyone's done it, but we're seeing some interesting opportunities there. So that's kind of where we are today.
Sunset Park and South Slope are 2 areas that we're focused on.
All right, good. Kunal?
Crown Heights, Prospect Lefferts, Flatbush, and from there and closer to the city.
All right, fantastic. Any over here, sorry?
We have a portfolio in Queens, and we keep seeing people from Brooklyn move to Queens. But I think there's a lot of turnover from. We've seen Williamsburg to Midwood. Looking for, there's that tipping point at which they don't want to share roommates anymore, and they, maybe strollers pop up and they need a bigger space for affordable rent, or they want their own. So they're looking at areas like Midwood, and they're looking at, areas like Bay Ridge, kind of interesting. The Williamsburg pioneers, they moved out to Bushwick. Now they're going into Ridgewood. They keep moving east, and now they're starting to sort of double back on themselves, and they're moving into areas like Sunset Park and Bay Ridge as far out. But there is a tipping point at which part people won't take the train that far. And what I think is interesting on that is it's all concentric circles of work and live, and the things that are going on in Long Island City are giving, and then stuff like the Cornell campus in Roosevelt Island are pushing people out on where you can access the F train or hook up to the BDM, the JMZ. Those are kind of interesting areas, but it's really that first pioneered group of Williamsburgians that are moving out. I think they're doing most of the moving.
I mean, from what I've been seeing is it's Williamsburg to Bushwick, Bushwick to Crown Heights, Crown Heights to Prospect Lefferts. That's where I've seen the younger populace moving in that kind of direction. I think that James is 100% right. As the pioneers of Williamsburg are getting older, opportunities like Midwood and Sunset Park are definitely options for them. So I think that's my take on the movement.
Energy efficiency is, the first reason to do it is savings, right? So it's, we can talk about the environment all we want, and we do. We have a very strong energy efficiency component to our platform. But really the first check the box is this going to save me money? And if it does, and then I also get the benefit of a lower carbon footprint, all the better, right? We can sleep much better at night. But if you're not really looking at energy efficiency, especially now that you've tasted a low oil market or a reduction in heating cost market, and you're saying, I want to keep it this way, because this is really, outside of this, you're in the red.
I mean, we don't see attendant demand for it, frankly. We do market it, but when we're looking at building, a key part of the business plan, and we have focused on rental growth in the top line, is going in on an expense and line item basis and saying, what can we do expense by expense, and whether that's replacing the windows or insulating roof cavities or putting in a dual fuel or gas boiler. Those are all critical parts of our business plan at each property that we try and hit in the first 12 months out of the gate.
All right, I think Lily's going to make thank you very much. Thanks, guys. I appreciate it.
So thank you, everyone. Thank you to all the speakers. Thank you to all the attendees. We really appreciate you being here today. Thank you to our sponsors and, of course, our partners, Apartments and Lofts, and Brooklyn Chamber of Commerce. Anyway, thank you for being here. See you next year.
Just to save you from